In 1998, while the world was worrying about the Y2K bug, a silent shockwave was already moving through the core of global finance. There were no dramatic headlines or crowds outside banks. Yet beneath the surface, the most sophisticated financial system ever built came dangerously close to breaking itself. At the center of this story is a type of Wall Street trader we don't often hear about. Not a reckless gambler, but a calm, analytical professional, trained to believe that markets, when observed long enough, reveal patterns. Patterns that can be measured, modeled, and exploited. This trader worked in a world ruled by probability, where risk wasn't feared, but quantified, and where extreme events were treated as mathematical curiosities, not real threats. This mindset was the dominant ideology of elite finance in the 1990s. And the firm that embodied this belief better than any other was long-term capital management, LTCM. It wasn't just another hedge fund. It was TE Hedge Fund, founded by John Meriwether, a Wall Street legend. But what truly set LTCM apart was its intellectual firepower. Inside its offices were two Nobel Prize winning economists, Robert Merton and Myron Scholes. Their work on option pricing had reshaped modern finance. To Wall Street, this was an unbeatable combination. The best trader, the best mathematicians, the most advanced models. If anyone had figured out how to tame financial risk, it was this group. And for a while, the results seemed to prove them right. In its first full year, LTCM delivered returns of more than 20% after fees. Banks lined up to do business with them. Goldman Sachs, Merrill Lynch, JP Morgan. These were the most sophisticated risk managers in the world, and they all reached the same conclusion: LTCM was safe. Their strategy sounded almost boring. They specialized in what's called convergence trades. They'd find two securities that were historically linked, like two different government bonds. When their prices temporarily diverged, LTCM would bet that they would eventually converge back to normal. One security was overpriced, the other underpriced. Sooner or later, rational markets would correct the difference. The profits on each trade were tiny, just a few basis points. But LTCM didn't rely on individual trades. They relied on scale. This is where leverage entered the picture. LTCM borrowed aggressively. For every dollar of investor capital, they borrowed between $25 and $30. With just under $5 billion in equity, LTCM controlled positions whose notional value exceeded $1 trillion. To the models, this wasn't dangerous. The historical data was deep. The probability of all their trades failing at once was astronomically small. According to LTCM's own risk estimates, losses of the magnitude they would later experience were expected to happen only once every several million years. This wasn't just arrogance. It was faith in mathematics. By 1997, LTCM had positions spanning dozens of countries, woven deeply into the global financial fabric. And then, the world changed. In August 1998, Russia defaulted on its domestic debt. According to the models, the impact should have been contained. But that assumption was catastrophically wrong. Fear spread faster than any equation could predict. Investors everywhere began selling risky assets. Not selectively, not rationally. They sold anything that wasn't perceived as absolutely safe. Liquidity vanished. Spreads exploded. Correlations that had held for decades broke down in days. For LTCM, this was a nightmare scenario. Their positions were built on the assumption that relationships between securities were stable. But now, those relationships were breaking. Losses began to accumulate. At first, a few $100 million. Painful, but not fatal. The models suggested the situation would reverse. Historically, it always had. But history was no longer a reliable guide. Margin calls arrived. Counterparties demanded more collateral. To meet these demands, LTCM was forced to sell, but selling only made the problem worse. Prices moved further against them. By September 1998, LTCM had lost more than $4 billion, over 90% of its capital. The fund was effectively insolvent. And this is where the story stops being about one hedge fund. Because LTCM wasn't isolated. Its trades were massive. Its counterparties were everywhere. If LTCM collapsed, its positions would be liquidated into already fragile markets. Prices would fall further. Other funds would suffer losses. Banks would face write-downs. A chain reaction. The Federal Reserve Bank of New York began quietly assessing the situation. What they saw alarmed them. This wasn't about saving a hedge fund. This was about preventing a systemic collapse. By mid-September 1998, LTCM was no longer just losing money. It was losing time. Inside the firm, the atmosphere shifted from confidence to controlled panic. Margin calls intensified. Banks that had once competed to lend to LTCM now wanted protection. LTCM tried to stabilize. They approached investors for fresh capital. They attempted to unwind positions strategically. There were no takers. Not because the assets were worthless, but because no one trusted the market enough to touch them. This is when the Federal Reserve Bank of New York stepped in. Not with press conferences, but with quiet phone calls. William McDonough, president of the New York Fed, began coordinating discussions with the largest banks on Wall Street. The message was blunt. A disorderly collapse of LTCM could trigger a chain reaction that would harm everyone in the room. This wasn't theory. It was arithmetic. Markets are not just mechanisms for pricing assets. They are networks of trust. And that trust was cracking. On September 23, 1998, representatives from the world's most powerful financial institutions gathered at the New York Fed. No cameras, no public statements, just urgency. The proposal was simple: a private sector rescue. 14 banks would inject capital into LTCM. In return, they would take control of the fund and manage an orderly unwinding of its positions. No taxpayer money, just collective self-preservation. The banks agreed to contribute a total of $3.625 billion. In exchange, they received 90% ownership of LTCM. John Meriwether and the original partners were effectively sidelined. Competitors became collaborators overnight. This alone revealed how serious the threat had become. The immediate danger subsided. Markets, sensing that forced liquidation had been avoided, began to calm. But the damage was done. The myth of perfect risk management was shattered. Over the following months, LTCM was slowly dismantled. By early 2000, the fund was effectively gone. No headlines, no public reckoning, but the lessons lingered. The Fed later acknowledged the intervention was to prevent a systemic crisis. Critics argued this created moral hazard, that sophisticated players might take greater risks knowing a rescue could happen if the system was threatened. They weren't wrong. As markets recovered, memory faded. Risk appetite returned. The conditions that made LTCM possible were not eliminated. They were normalized. The story wasn't over. It was only waiting for the next chapter. In the years that followed, the financial world did what it does best. It moved on. The problem had never been a lack of intelligence. The problem was structural. Incentives still rewarded leverage. Complexity still obscured true risk. And success still bred overconfidence. The tools became more powerful, the models more convincing, but they still relied on the same core assumption that had failed in 1998, that markets behave within predictable statistical boundaries. That assumption would fail again a decade later. In 2008, many of the same dynamics were visible. Excessive leverage, blind faith in models, and instruments designed to distribute risk that instead concentrated it. Once again, correlations moved toward one. Once again, liquidity vanished. The institutions were larger, the instruments more complex, but the logic was familiar. The rescue of LTCM was quiet. The rescue of the global banking system in 2008 was not. But both revealed the same uncomfortable truth. When financial networks become sufficiently interconnected, failure is no longer individual. It is collective. This is why the story of LTCM matters. Not because it was the biggest crisis, but because it revealed how close modern finance can come to collapse without anyone noticing. A loud crisis invites reaction. A quiet one invites repetition. The real legacy of LTCM was not regulatory reform. It was normalization. The idea that a private institution could become systemically important quietly entered financial consciousness. Risk did not disappear. It moved. The uncomfortable truth is that LTCM did not break the rules of finance. It perfected them. It optimized leverage. It diversified exposures. It trusted models built on decades of data. And that is why it nearly broke the world. This forces a question that few in finance are eager to answer. If brilliance, discipline, and sophistication are not enough, what is? There is no clean solution, because systemic risk is not a technical problem. It is a behavioral one. The system survives not because it is safe, but because collapse is often delayed. Delayed just long enough to be forgotten. The crisis of LTCM matters because it strips away comforting illusions. It shows that stability can be an illusion created by leverage, not a permanent feature of markets. And most importantly, it shows that the most dangerous financial events do not announce themselves as crises. They announce themselves as confidence. Confidence that risk is understood. Confidence that models are sufficient. And confidence that someone, somewhere, is watching the whole system. Often, no one is. Understanding this story isn't about predicting the next crisis. It's about recognizing the conditions that make crises inevitable. Because the next collapse will not begin with panic. It will begin with certainty. And by the time certainty breaks, it will already be too late. Thanks for watching. If you found this story interesting, consider subscribing for more deep dives into the events that shape our world.